Yo, why do some banks survive a crisis while others fail? It all comes down to capital and liquidity.
Let's break that down because it sounds boring, but trust me, this is the difference between a bank staying alive or completely collapsing.
Capital is basically a bank's cushion. It's the money shareholders and owners put in plus the profits that they keep. The more capital a bank has, the more losses they can eat before they go under.
Think about it like this. If a bank makes a bad loan and loses money, strong capital means they can take the hit and keep going. Weak capital, one mistake and they're done.
Then there's liquidity. Liquidity is simply how much cash or near cash a bank has ready. It's what they use to pay people who show up and say, yo, I want my money back right now.
Silicon Valley Bank in 2023 is the perfect example. They had assets, but most of it was tied up in long-term bonds. When depositors rushed to pull money out after a scare, they didn't have enough liquid cash. And boom, they were gone.
And this isn't new. Back in 2008, tons of banks had risky assets and way too little capital. Once losses started piling up, they couldn't handle it. And that led to a global meltdown. But we'll talk about that another day.
That's why regulators today force banks to hold minimum levels of capital and liquid assets. It's like mandatory safety gear. You can't skip it if you want to play the game.
So yeah, a bank can talk about having billions in assets, but if it doesn't have solid capital and liquidity, it's basically a house of cards.